This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
On this week's show, the base case for this being it, the new normal, the same as the old normal, why it's time to stop thinking we'll soon return to the pre-pandemic economy anytime soon. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. We spend a lot of time on the show talking about the macroeconomy, the markets, individual stocks, because in reverse order, they're typically more compelling than talking about actual bigger issues, ones that actually have a much bigger impact on your long-term ability to acquire, to grow, and to maintain wealth. But we need to at least recognize that these other topics, they may not be as much of a draw on a podcast. They may not garner the attention of someone who may want to catch a quick idea to plunge into an investment on Monday morning, which is a terrible idea. You should not be taking ideas from this show and running out and buying them. But this is information that you should use for a more holistic approach to how to really be safe with your financial dealings. And these other concepts are really what's going to drive the big results over time. No, I'm not turning this into a financial planning episode this week, but I did want to recognize those efforts, like the work we did recently in the office with a client, taking what was really a really tough personal situation, which had it resulted in massive negative income, not by our fault, but by what was going on. And we made sure that we could at least identify the financial ramifications and take care of some, I'll say the side effects, as I'm trying to be kind of obtuse here, the side effects, and really have massive positive financial results over time that otherwise could have been overlooked. Anyway, I just want to stop for a moment as I now refocus on the investment side and point out that largely very little else matters here. It's all details in the periphery except for valuation and interest rates. You know, if the connection between those two factors favors asset valuations, if interest rates head lower and it allows existing low valuations to therefore trend higher, then assets will rise. And if assets are already expensive, and I mean that on a historical level for hard assets like real estate, especially relative to what it costs to finance purchases and develop real estate, and if stocks are expensive relative to what the markets think they're going to earn, even if that earnings growth is good and actually occurs, well, if the interest rates rise, then all things else being equal, those prices are going to be challenged. And once those trends are accounted for, then we can worry about demographic demand for housing, the trends in commercial real estate, what sectors may do better in this economy, where there is value in the stock market, the effects of artificial intelligence on earnings, all these things. But when we get the benchmark 10-year interest rate, the 10-year Treasury yield, breaking out to new recent highs, then there's going to be a price to pay. And the changes in interest rates have an effect on an economy, in that there's less cash available, borrowing money is harder, it costs more to build and borrow a house. But first, simply, just the rates themselves going higher make future outcomes, future earnings, the value of hard assets in the future, at least in some cases, it makes them worth less than they otherwise were at lower rates. And that's the crux of what we have here in August for the markets. We saw the 10-year Treasury rate go from 3.92% at the end of July, which is substantially higher already than where it was a year ago. But we saw it now break out to about as high as 4.35% this past week, which was a level that was unmatched in this rally in rates. I should say sell-off in bonds, this rally in interest rates. It's a level that hasn't been seen since 2007. And that's a big deal. It's something that I've referred to before earlier this year on this podcast, which is that this isn't new, and this isn't a matter of just waiting long enough to see us get back to a period of zero interest rates that we've enjoyed for the last 10 or 15 years. But this may be and maybe at best, a return to that old normal of where things were before the great financial crisis, back where interest rates were in 2007, because you'd really need to otherwise go back to the early 1960s to find interest rates below where we are today again. If you ignore what the last decade plus had done when they drove interest rates into the ground and you thought that that was some kind of normal, well, to get back to before that to where we were below today, you have to go 60 years ago. And this was touched on in the Wall Street Journal over a week ago, and I'm going to quote the quote that they quoted in that article because I liked it. They cited The Hitchhiker's Guide to the Galaxy, where a character in what I consider a science fiction masterpiece, and I'm not going to try to explain the whole book here if you're not familiar with it, but the character said, "We have normality." I repeat, we have normality. Anything you still can't cope with is therefore your own problem, end quote. And that's a great quote for how I'm feeling after we've allowed so much cheap cash to boost assets and forward discounted free cash flow evaluations for really over a decade now. And now we're back to needing assets to stand up and perform on their own. Anything that company can't cope with on its own is its own fault and problem. And in that journal article, which was called "Investors Need to Worry About the Bond Market's Return to Normality," they pointed out that TIPS had reached a yield of 1.89%, which doesn't sound very high, but we'll get to that in a second. But that's the highest level TIPS have traded at since 2009. And a quick crash course here, real quick, to explain what's happened here. A TIP is a treasury bond that adjusts the value of the bond by the rate of inflation. So the yield offered for one in the market is the difference between the underlying treasury, in this case, the 10-year treasury, and the market's assumption for inflation. So it's a reasonable way of hedging inflation, but really only in regards to what that treasury yield would have been otherwise as an alternative. So in this case, we have a 10-year treasury that's now yielding, let's say, 4.25%. So the market's assumption is that inflation is going to average 2.36% per year for the next 10 years because it's giving you an outright yield of 1.89% plus inflation. So if you were going to buy a 10-year treasury and you think inflation is going to be higher than 2.36% per year, blah, 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 you get the TIP is a better deal. Doesn't give you complete protection against inflation, only protects you against inflation versus that treasury or maybe versus sitting in cash for a decade. But the larger point may be bigger than the built-in assumption that inflation here is going to average about 2.4% for the next 10 years. Again, you got to factor in that it's not there today. So in that 10-year assumption is the factor that it's already running at, well, over 3% at least for the next year, I'm comfortable saying. Anyway, the bigger deal here is that we've returned not to a level of higher rates, but a level of normal rates, of where benchmark rates have historically found traction as a ratio to inflation plus economic growth. And as for that inflation rate, well, that's factoring in a return to normal and matches really the Fed's assumptions and the target by which they're acting upon too. Because the Fed's not coming off of their target, but they are making it clear that their target is 2%, right? They say it over again, but it's not 2% now. It's not 2% at the end of 2023. Their stated goal is inflation will be 2% in 2025. That should give them at least license to let this kind of glide path continue as long as that path does continue trending towards that goal without much further action. This is why we're now willing to say, or they're willing to say, in fact, quote, they've probably done enough for now, end quote, according to the Philly Fed president in an interview this past week. But there's no sign on the horizon for cuts anytime soon. And basically, this is what mission accomplished sounds like coming from central bankers, because they're not going to ever probably say mission accomplished, but they're starting to really wave the green flag in this case. Evidence that we are likely return to this old normal, though, instead of this being a diversion from an otherwise permanent condition of low interest rates, is not only the historical trends but really the data affecting monetary, if not unfortunately fiscal policy here. The contrary possibility against what I'm saying here is that modern globalist theory and this world we live in has led to a condition of otherwise permanent interest rates trending lower and assets therefore commanding higher valuations, as we've seen rates march really steadily lower since 1981, with little spikes along the way if you were to map out a chart from that point. And with these little spikes and divergences along the way, you can look at a 40-year chart, so a convincing amount that shows interest rates just going lower and lower and lower. However, that would also start us from a period of unusually high rates in inflation. And even then, we reached and stabilized at a 10-year Treasury rate of roughly 4 to 4.5% and bounced around there for quite a long period of time. Again, little spikes and stuff along the way. I mean, there were recessions along the way, but that's kind of the equilibrium point, more or less, until the great financial crisis, when they pulled out all the stops, they pulled the legs out, interest rates crashed and approached zero, and basically stayed there with attempts to go higher until the pandemic, and they went back to zero again. But the evidence beyond the trends can be found in the bankers and the economists' search for this so-called neutral rate, which is the underlying interest rate at which it's believed that there's this economic balance between consistent, steady growth and modest inflation, where interest rates aren't hitting the brakes on the economy, nor interest rates so low that they're stoking the fire of the economy. Because inflation is falling now towards the target inflation rates, and because it continues to do so while the economy is still growing and unemployment is remaining largely low and stable, this is being described that we're now seeing the economy maybe at the neutral rate right here, rather than the assumed lower levels where it had previously been presumed to be. You know, it's this neutral rate is never clearly defined as to where it is or what constructs that, but instead it's more of a theory that's just speculated about and therefore targeted. But if indeed these policymakers believe that the evidence that we have here today is that the neutral rate on yields and that this level actually isn't constrictive to the economy or actually slowing the economy, then any argument for the Fed to someday in the near future lower their target rates again is completely lost, as they'd really only have to do so when and if the economy slowed and unemployment started to rise in a meaningful way. In other words, and I'm going to take a quick break in a second and move on from all of this, but in other words, if we're here today at this equilibrium point, economy is doing well, folks are largely employed, inflation is trending towards the targets, then folks must stop assuming that the Fed will lower rates once they're convinced that inflation has reached their goals and stop there. Instead, we're going to have to start assuming that this is us having returned to normal after a 15-year hiatus from what normal rates are in an economy like ours. Okay, quick break here. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be right back in a moment.
Stocks and bonds are volatile, but your financial plan doesn't have to be. Have you sat down to map out an investment plan you can trust when emotions and headlines stir panic? I'm Simon Hamilton with the Wise Investor Show. Every week we discuss the latest financial trends and what investors need to know. To learn more about how to stay grounded and to become a better informed, wise investor, listen to the Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. Before the break, I was talking about the so-called neutral rate, and I also want to point out that what we've seen here in August, this breakout in interest rates to new recent highs, levels which now match where we were before 2008, well, they might reflect the neutral rate of a balanced economy, but that does not mean that they won't slow down some things for now. Most importantly, they'll continue to affect those assets which have otherwise defied the effects of higher rates over this past year or so, and those that are still adapting to maybe where those prices should be. And most notably, this is the effect that rates have on real estate. But real estate has had so many other factors impacting their various values now that they haven't settled into the old normal pricing models yet in many cases that would be more largely based on prevailing rates. Commercial real estate has been beat up pretty good, especially anything that's not considered Class A or not in what I would say a premium city or a combination of both. Those properties are not only affected by interest rates, but of course they're also now being affected by us not shopping in malls like we once did and not requiring as much office space as we once did and so on. But housing has been much more resilient, and it still has factors driving demand which have defied the effects of what are now over 7% mortgage rates and largely kept prices pretty high. And this boils down to demand still outstripping supply. We're still seeing a lot of new household creation in the U.S., both from millennial and younger generations gobbling up their first homes, as well as immigration, contributing to overall demand. And also, despite the boomers retiring and maybe in many cases seeking to downsize or simply to move somewhere where the climate suits their clothes, despite that, supply is still constrained because so many folks still have debt on their homes, they have mortgages, and they've locked that rate in at such low levels that in many cases they can't reasonably move unless they're really forced to. You know, if you're sitting there in a mortgage rate of 2.5% and you consider moving to a place where you can't pay outright, well, that's going to be a lot of pain if you're going to change from a 2.5% mortgage to a 7% mortgage. It's not enough of a sample size, but I got at least some anecdotal evidence to this point. This past week, we got both the July new home sales data and the existing home sales data. The existing home sales, according to FactSet, were 4,070,000 homes for July versus expectations of 4,150,000. And that overall reflected a decrease of 2%, while prices increased 2% versus a year ago, despite considerably higher mortgage rates, while new home sales, newly built homes, were 714,000 versus expectations of 706,000 for the same period. So more new homes being sold and fewer existing homes being sold versus the expectations. And this is a bit of an example of why maybe Warren Buffett's been buying up home builders, because they can't build them fast enough to meet demand, and the prices are defying these higher interest on mortgage rates, for now at least. So for now, one last bit about getting back to the old normal. A lot of the assumptions being made about where the Fed goes from here is based upon the unemployment rates. And in July, the U.S. economy added 187,000 jobs, which was lower than the forecasted 200,000 jobs, according to the Wall Street Journal. And we're still adding a lot of new jobs now, and we're seeing the costs, and everyone's hearing about the struggles to find labor wherever they go. But we are expected to add about 1.4 million workers to the workforce over the next year through various means. So we need to keep the new job creation roughly at about 50,000 new jobs per month. It's estimated to keep the unemployment rate roughly where it is right now. Or another way of addressing that is to increase the participation rate, which I think is actually one of the more misleading measurements in economics. It's a great way to kind of map out the change in the rate. That's telling how much it's gone up and down over a month or a year. But on an absolute basis, it's challenged by its methods and basically our nation's demographics. The participation rate is calculated by how many eligible people in the workforce are working. And they define that by everyone who's 17 years old or older. So in other words, not only are full-time college students not working counted as unemployed, but as boomers do retire, they remain in that head count. If you're a 90-year-old person living in an assisted living center, you are considered part of the participation rate as not participating as an eligible worker. So this number is bound to trend lower, I think, over the next few years because of these retiring boomers. But if we're using it to measure participation month over month or year over year, we can see that more folks are coming into the workforce while others are remaining in it and not retiring as quickly. The rate now stands at 62.6%, which is versus the peak we hit just as the pandemic started when everything was cranking. Participation rate, according to the journal, was 67.3%. So that is telling. Demographics have shifted a little, but we had 5% lower participation rate. And what this all means, as I quoted that character at the beginning of the show, is we've achieved normality, and any persisting problems are solely your own or solely that of the operator, the corporation, et cetera. This landscape of what it now costs to borrow money, to find and hire new employees and such, it's not, I think, likely a passing phase. There are a lot of companies that are adapting well to it and are growing their revenues, they're growing their earnings, but others are struggling, and many households are starting to feel the strain. I am cautiously optimistic, but in a stock market that is trading now at roughly 20 times the consensus estimate for next year's earnings, according to FactSet, and basing that off of an expected growth rate of earnings of 12% for next year, we need to be aware that these underlying conditions are here to stay, and we may have to be careful with these valuations and how much good is already priced into some of these high-flying stocks. Maybe we do fine next year and we see an average earnings growth rate of 6 or 7%, but that's disappointing what the market's pricing in today. And if that's what happens, we don't have to go off a cliff as an economy, but the stock market may not do so well if it's already priced in today 12% earnings growth for next year. That's what we need to be careful with. That's all I have this week. If nothing else, I hope it helps you here to take a breath and be prudently cautious when making investment choices. Don't let the fear of missing out guide you when you see some of what's happening in the markets these days. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.